Why not then adopt the Charlie Evans approach and wait till you see inflation accelerate before you raise rates?
So here's why. I believe we should take a balanced approach to monetary policy. It means, yeah, we have a dual mandate, full employment and price stability, i.e. the 2% target. But we are already at or near full employment now. I believe we're going to overshoot full employment in the next year. I balance that against the fact that we're undershooting our inflation target, but it's not one or the other. I think you've got to balance the two, and the degree of the overshoot is such. My concern is if we wait too long to remove accommodation, we're going to be playing catch up. And the history of playing catch up by the Fed is not a happy one. The history when we overshoot full employment is that that tends to lead to a recession because the Fed has to play catch up and balances build. And so I think a more gradual, patient approach will serve us much better.
The yield curve, a lot of talk in the markets about that. One of your colleagues worries about inversion and recession in the coming year. What do you think?
I'm worried about it too, and I think we need to watch it. So the 10-year Treasury, high 230s, 240 is meaningful, and here's why. The history of inversions is such that it has tended to be a pretty reliable forward indicator of recession. Now, this time may be different, but I wouldn't count on it. And so with the Fed funds rate at 125 to 150, I can tell you I will be watching very carefully the 10-year Treasury as we go into 2018 because it limits the operating flexibility, in my judgment, for the Fed in terms of how much and how fast we can raise rates.